You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to another episode of OIC's Wide World of Options. My name is Mark Benzaquen, and joining me today in the studio is Roma Colwell, a 25-year options veteran with roles ranging from educator, risk manager, pit trader, and now an instructor here at OIC. Roma, welcome.
Yeah, thanks, Mark. I'm happy to be here.
So, Roma, as you know, on our last podcast, Matt Cashman and I discussed trading options as potential income generators. And as many of our listeners requested further discussions, I wanted to continue with the topic by taking a look at two of the more popular selling strategies, namely covered calls and its cousin, the poor man's covered call. Let's start with covered calls, Roma. What are some of the aspects of covered calls beginner investors should know before trading?
Yeah, so let's start with that. A covered call is an income generating strategy. Typically people put this on when they're, neutral to maybe a little bit bullish, but for the most part, it's to, generate some extra income as long as you don't think the stock is going to.
Right. So you're not going to put the strategy on if you think the stock's going to go to the stratosphere.
Right. Exactly. So a covered call essentially is a long stock position and a short call position. Now you can put them on simultaneously at the same time. That's usually called a buy right. But for the most part, people are already long the stock and they're looking at ways to, increase their return on that stock that they're long.
Okay, so they've got to buy the stock. So they have to buy 100 shares of stock, either already owning those shares in their portfolio, or they have to purchase them at the time of selling the call. That would be a buy right.
Mm-hmm.
In the 100 shares of stock, if it's a $50 stock, they've got to put $5,000 of capital up front. If it's one of these bigger names in stocks currently in the market that's trading $1,000, $2,000, $3,000 a share, it's it's going to require significantly more capital up front, correct?
That is correct. So you do still have the same kind of downside that you would have if you owned the stock. So if it went to zero, you would lose, your investment. That call that you sell, right? You collect that premium. That is your premium to keep. But in terms of downside risk, it only helps you just a little bit. And that little bit is that premium that you sold it for.
Okay. And then sticking with that risk topic, because we're selling options, we know that whenever we sell options, we're at risk of assignment. So I'm assuming with the covered call, that's one of the risks as well, getting assigned on that stock, right?
Oh, yeah, absolutely. I mean, there's there's some upsides and there's some downsides, right? One of the downsides is when, there's going to be a dividend paid, right? So the person that's long the call is going to want that dividend. So they're probably going to exercise their call if the call is in the money and, valued at a place that makes sense to collect the dividend. So that's your risk. If you get assigned for a dividend, you're not going to collect that dividend because you're going to be required to sell the stock and deliver that dividend that goes along with it. Now, the upside of it, if you are assigned, you are getting your max profit. And that max profit is the difference between, where you bought the stock, the strike that you're short, the difference there, plus the premium that you sold the option for.
So that strike that we're short, we can kind of think of that as the exit price at where we're willing to let that stock go, which is the inherent feature of covered calls, that the call seller not only needs to be prepared with delivering that stock, but they have to be willing to let it go. Right. If you're as we mentioned earlier, if you're very bullish on the stock, this may not be a strategy for you because you do have that risk of getting those shares called away. So this strategy is maybe more appropriate for people that maybe aren't married, for lack of a better word, married to the stock, or investors that certainly are willing to let that stock go at a specific price, right? And that's that strike price.
Yeah, absolutely. You can look at a covered call also as an exit strategy, right? So depending on what your forecast is, you may decide that I want to sell it at this price, which is above where it's trading now. And if I don't, I get to keep that premium, right? So I know that when I used to trade, that was one of the ways that I would look at getting out of an option, out of my stock. Instead of just selling the stock, somebody's going to pay me to, basically where they want to buy it, but they're going to pay me some extra money. So I select where I want to sell it, collect that premium.
Right. So let's say you've got, you own stock at $50. Maybe you're willing to let it go for $55 if the stock price appreciates. Mm-hmm. And maybe, so that $55, that would be our exit price. That would be the strike price that we choose to sell. Mm-hmm. And assuming, hypothetically, that 55 call has a dollar premium attached to it, if you get assigned, if stock goes to $55 or beyond, hits your strike price or beyond, you sell your shares at $55 plus that extra $1 that you generated when you sold the option, you're actually selling the stock at 56.
Yep, exactly. And if that doesn't happen, another way to look at this is, that purchase price that you had at 50, if it doesn't go to 55, you effectively have lowered your purchase price down to 59 because you've collected that dollar that you sold it for.
To 49, right.
To 49, yeah.
So you're lowering your cost basis by the amount of the premium that you collected.
Mm-hmm.
Okay. So let's shift gears for a second. We talked in the beginning about that required capital that you've got to buy 100 shares of stock. Mm-hmm. $50 stock, you've got to put up $5,000. A $3,000 stock, you've got to put up $300,000. So certainly a significant amount of capital, which leads me to believe that this strategy may not, as it is, the traditional covered call, may not be as suitable or attainable or realistic for some of these bigger names in stock that we see out there today that are trading $1,000 a share or more.
Okay.
The cousin of the covered call, as I referred to it earlier, is that poor man's covered call. And I'm assuming that addresses that capital requirement. How does that work?
Yeah, absolutely. Now, just to give you a little background, before leaps, now this is what we're talking about, long-term options, right, that can go out a year, year and a half, as far as, 2.5 years out. When I was, before they came around, options only went out 9 months. And our customers wanted an alternative, right? This was their alternative to purchasing stock at a lower price. So leaps were created, which was a tool for those that want to invest in these products that are more expensive at a significantly lower price. So yes, it's an alternative looking at a leap. Now, I would say the caveat of all this is that if I'm going to buy a leap, I'm going to want something that, relatively moves with the underlying as much as I can.
Right. Something that correlates to the stock price. Stock price moves obviously dollar for dollar. Right. Something that moves as close to that as possible, theoretically.
So 70 cents for every dollar, or 80 cents for every dollar move.
Okay. And the idea being is that by purchasing the leap, then let's say we look at a deep in the money call. You had mentioned, 70 cents for every dollar, 80 cents for every dollar. So we're talking about deltas. So we're looking at a deeper delta, deeper in the money call that's going to more closely correlate with the stock price. And let's just say that deep in the money call costs $10. As each option contract typically represents a controlling interest in 100 shares, that $10 is $1,000 worth of premium that you'd be paying for the option. But on a $100 stock, it's $1,000 for the option, or it's $10,000 for the stock. So that's where we get that lower capital requirement, hence the poor man's covered call. But other than that, is it still a covered call in the traditional sense, meaning the stock can get assigned, called, well, maybe not the stock because you don't currently own it, but that short call is still at risk of assignment, right?
Right. Yeah, it's still at risk of assignment. Now, if you're long a leap, you're not entitled to the dividend.
Okay.
Right. So that is one of the disadvantages of it. So if a dividend is going to be paid, you do have some risk on your short call. And that risk is that you could be assigned. And if you are assigned, you will come in the next day and find yourself short stock against a long leap position, which lends yourself to making, a decision, right? Whether or not you want to exercise your leap, which might, cost you a little bit of money, that whatever that time premium is built into that leap, or you could choose to buy the stock back. You do have that overnight risk that, the stock may open up. If you're shorted, it could open down if you're lucky. So you have the overnight risk. And then the other piece of this is that you don't have a cover call on anymore. You have a whole new position, which is long the leap, short a stock. And that's something you probably have to talk to your brokerage firm if you wanted to hold that position for longer than that day.
Okay, so let's go through a scenario. We've got the poor man's covered call on, and let's say hypothetically stock's trading $100. We look at a deep in the money call, and let's say we choose an 80 strike. Again, arbitrary numbers. That 80 strike in the money by $20. Let's say it's going to cost us $22 in premium. So $2,200 of premium that we pay up front. We end up selling a 105 strike call against it, and we collect $1.
Okay.
So let's lay that as our scenario. Stock goes to, and let's say 2 months in, let's say 60 days, stock goes to $106. So now our 105 call, it's in the money by $1. Expiration comes, we get assigned. Now we are short stock at what, 105?
Yeah.
Short stock at 105. We can exercise our 80 strike call the following day. So we've got that overnight exposure, as you had mentioned.
Right.
We can exercise our 80 strike call the next day and buy stock for 80 that we are short from 105. But you had mentioned something about foregoing any time premium. So if we exercise that 80 strike call, we're going to exercise it basically for $25, right? Stock's at 105. We exercise the 80 strike call, $25. But if it's trading $27 in the market, that's what you're talking about. We're giving up that extra $2.
Right.
So rather than do that, maybe it's better to just buy the stock outright to satisfy that short stock position.
Oh, yeah. The scenario that you just gave, if the stock is trading 106, we're short to 105,
right.
And we bought the stock essentially at $102, right? We've got a profit there. And yet you're at risk for the time premium on it. And I don't know what the time premium would be with the stock trading 106 on that, but there'd be a little bit of money.
Right.
But that particular trade, if we were assigned and then we decided to exercise our leap, as long as the stock is not moved, we've got a profitable trade there. But that's not always the case. A lot of times, the price that you've paid for your leap is greater than that time premium is greater than $2.
Okay. Let's shift gears for a second. So, kind of back to the just selling options in general, as opposed to specifically the covered calls. That I refer to as a rinse and repeat strategy. So basically we've got the covered call on, we get assigned, we get the cash from selling the shares that we deliver to the exerciser. Now we've got cash in our pocket. To stick with the selling options theme that we're on, what some investors might do is take that cash and sell a cash secured put. Right. So they like that stock that they were long to begin with. They ended up selling it through the covered call. Now they've got cash in their pocket. They sell a cash secured put, again, generating more income. You had mentioned that premium that we collect. That's all income in our pocket, regardless of what happens, come expiration, whether we're assigned, whether we exercise, what have you. Sell a cash secured put. And now we see what happens, right? If that option, that short put now gets assigned, now we buy stock and then we sell a covered call against it, et cetera, et cetera, et cetera. So then after we get assigned on that short call, we collect the cash, we go ahead and deliver the stock. With that cash in our pocket, we then sell a cash secured put. If we get assigned on that, we end up, we're long stock again, right? Is that, where do you see that going? Where does that lead to?
Yeah. So the thing that I'm going to point out about both of these strategies, selling a cash secure put and doing a covered call is actually the same strategy. And I say that if you were to graph it out, for those of you out there that want to look at a graph, you'll see that they look identical. So when you're selecting your price to sell your cash secured put, right, you're selling it at a price where you don't mind buying the stock. And I always kind of look at that as somebody paying me to buy the stock where I want to buy it, right? So I'm collecting that premium that somebody just decided that they need some protection, whatever reason they have. So I'll sell that cash secured put. And of course, if it never gets there, I just keep the premium. And if it does, then I'm holding stock. And it just makes sense for me to look at an exit strategy of putting that covered call on. And I'll sell the call against it. Hopefully it gets there. If it doesn't, I keep that premium. And then I'll do it again. I'll sell another call. But as soon as I'm assigned, then I go back to that put. So it's a strategy in terms of having your forecast where the stock is going to be trading in between, two prices, whatever you think, wherever you'd like to buy the stock at and wherever you'd like to sell the stock at.
Right. So in this case, the cash secured put, the strike price would be the entry price for the stock purchase. With the covered call, the strike price would be the exit price for the stock sale.
Yes, absolutely.
Okay, excellent. So Roma, getting back to the determination of early exercise or the probability that an investor will be assigned early as a result of a dividend, I know that on the street, for example, there's kind of a rule of thumb amongst beginner investors that they look at the time value in the call option, and if that time value is less than the amount of that anticipated dividend, that the short call is then a candidate for early exercise, right? That's the rule of thumb on the street. But I know that market makers, for example, and certainly somebody of your experience, has a different method that might be a little bit easier to look at or a little bit less complicated to understand. So take me through that.
Yeah, so I think we have to keep in mind that calls and puts have relationships. And part of that relationship is time value. And
that relationship, is that put call parity that you're talking about?
Yes, exactly. So you will, so when you're trying to, to come up with that time value, right? That time value, because there is this relationship between the call and the put, time value in a call is the same as the time value in the put. Then pretty close, probably within a few cents. So if I were looking at whether or not there's a potential for assignment, instead of doing all that calculation, I would examine what that put is trading at. And if that put is trading at less than the dividend that is being paid, then I would, say to myself, there's a possibility that I'm going to be assigned on that call.
Okay. And the relationship that you were talking about, that's the put call parity, where, if we know a stock price, strike price, and either the call or the put price, we can then use the principle of put call parity to find out the price of the other. And that relationship between calls, puts, stock, and strike is also important when it comes to synthetic options, synthetic relationships where you can replicate one position, let's say long stock, for example, with two option positions, a long call and a short put of the same strike, same expiration. So that option position, long call, short put, replicates a long stock position. And the reason I bring this up, you had mentioned earlier about the cash secured put and the covered call being, very, very, very similar to each other. But that covered call in and of itself is a synthetic position, right?
Exactly. It is a synthetic position, and it's a synthetic short put position is what it is.
Well, that's excellent, Roma. Thank you. Very, very insightful. And certainly, thank you for joining me today. Very happy to talk with you about options.
Yeah, it has been absolutely my pleasure to be here with you, Mark.
Well, thank you. And thank you to all of our listeners and supporters out there. Before we sign off, I want to invite everyone to send us your questions to be featured in the future segment of OIC's Wide World of Options. You can contact us via email at options@theocc.com or live chat with us on our website, www.optionseducation.org. And while we'll respond to your questions directly, we might also choose to share your question with our listeners in the future. So please tune in again next time. Thanks again for all those that are listening, and we'll be talking with you again very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.